The following is a presentation of TFNN. The Morning Market Kickoff with your host, Tommy O'Brien. Now, Tommy O'Brien.
Good Monday morning, everybody. I'm Tommy O'Brien, coming to you live from TFNN just after 9 a.m. Eastern Time as we kick off the trading week. And we got markets picking up where we left off on Friday. Positive territory. S&Ps right now up by 19 points, trading at 39.34. See the acceleration on Friday. We get the non-farm payroll numbers, unemployment actually coming down, but the wage data, the market liked. They liked all of it, basically, as that market accelerated. You're talking about 100 points on Friday. We're coming into the opening bell right now, basically right near pre-market session highs. You got 3 points above that level just in the last half hour or so. These are 5-minute bars we're looking at. You're trading at 39.35. NASDAQ 100. Talk about from 10,751. What is that? We're talking about 450 points almost to the upside. For the NASDAQ 100, we'll talk about them as we come into earnings season. Tech stocks later this month. Banks kick things off on Friday. We get CPI data on Thursday, which should be a big one. We'll talk about that in a moment. Dow up 120 points, we'll call it. 33,890, pushing the 34,000 mark in the Dow. Just Thursday, we had a 32,000 handle in the Dow. And the Russell up by 10 points as well. Commodities, crude catching a bid. We were just at $76. You have the gold contract up by another $12 right now at $18.82. We reached $18.85 overnight. We'll pull up the dollar. We got some action in notes and bonds. You're talking about higher price and lower yield coming at you off of that jobs number. All I can say is you only got a few days until we get more data on Thursday, the CPI data. The market will be paying close attention to that. And it seems like expectations are going to be pretty high that with the wage data, possibly, the impact of the Fed is coming into the market. We're going to get that data on Thursday, man. And if it does not line up with kind of the rhetoric, I mean, you're talking about a price level right near 4,000 in the S&Ps. We'll talk about some of the banks out there talking about potential for trading lower in this market as we come into earnings season. Let's jump over to the dollar. Dollar index, what are we getting? Yes, lower dollar. I have to reset my brain for all the calibrations, right? So it's lining up just like it did on Friday. We have lower yields, which is attracting a weaker dollar, which the market is loving, trading higher, okay? You have the S&Ps. Now, this has to line up with the Fed, though, folks, all right? The data has to agree with this going forward because the markets are lining up right now in terms of a trade where lower wage growth is going to help with inflation. That's going to bring the Fed what they need to potentially be able to lower rates or at least stop hiking in the near term. And that will attract less dollars as you have a lower yield in the U.S., attracting less demand for U.S. dollars. Okay, so you have a weaker dollar, you have lower yield, and the market says, yeah, we like that. As we have a lower yield, maybe we'll be nearing the end of the Fed. And guess what, man? We come into the Fed, 3 weeks about? I think the Fed has a January 31st, February 1st meeting is where they line up in terms of their next meeting. So you're talking about only 3 weeks. We get the CPI data on Thursday, January 12th. We have basically all the big banks kick off earnings season on the 13th. And then what does go into this is that we're going to get big tech earnings in a couple weeks. I believe most of them, will pull them up, are basically the week of January 23rd. Let's check it out right now, and let's see how they're all trading this morning. We got Apple shares. Quite an acceleration on Friday, holding on to the gains. You're talking about $5, man. And I always say it, Apple's got 16 billion shares outstanding, folks. Friday alone, adding about $80 billion of market cap to that equity. Just staggering, considering how many shares are outstanding in that company. We jump over to the Analyze tab. We jump over to the Earnings tab. So Apple's out late. Yeah, they're out February 2nd. Where does that line up? Look how late they are. So we got to wait a while until we get Apple earnings. You're talking about almost 4 weeks, 3.5 weeks for Apple earnings. Amazon earnings, same day. So Apple and Amazon all the way into February 2nd. See Microsoft. as we come into this first break. Yeah, there they are. So Microsoft, January 24th. So 2 weeks from tomorrow. We'll talk about some of the others. Let's see where Google is as we come into this break. Google, January 31st. So they're going to be sprinkled over the period of about 2 weeks. Last week in January and then that first week in February. Stay tuned, folks. We'll be coming back in 3 minutes. If you're looking for potential trading setups in the stock market, then Rocket Equities and Options Report is a newsletter you should try. Tommy O'Brien delivers options and equity trades when the markets present them using a combination of fundamentals and technicals. Sign up for Rocket Equities and Options Report today with a 30-day money-back guarantee so you have nothing to risk. For all the details and to start your subscription today, visit the front page of TFNN.com. TFNN, educating investors.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
Steve Rhodes started his trading career as a student almost 20 years ago, and the student has now become the master. Steve won the prestigious Timer of the Year award in 2018 and barely missed that mark again in 2019, finishing at number 2 for the year. An amazing accomplishment. Steve Rhodes is committed to sharing his techniques and knowledge with anyone who wants to learn, and he shares his vast amount of trading knowledge every day in his Mastering Probability newsletter. Steve's award-winning newsletter, Mastering Probability, is delivered every trading day with updates throughout the afternoon. Sign up for Steve's market newsletter, Mastering Probability, and you'll receive access to 7 of Steve's educational webinars absolutely free. At TFNN, all our newsletters come with a 30-day money-back guarantee, so you have absolutely nothing to worry about. Visit TFNN.com and try Mastering Probability 30 days risk-free today. TFNN, educating investors.
TFNN has launched the Tiger's Den, hosted at Discord. TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. The Tiger's Den, available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. Sign up today and become a part of this educational community of traders. Just visit the front page of TFNN.com.
Welcome back, folks. We have the S&Ps right now trading up 19 points. You have the NASDAQ futures up 65. You get the Dow up 114. Give us a call, folks, 877-927-6648. We got a call last week, and it was talking about, I think it was from Mike in Ormond Beach, and he was talking about turning on some new listeners. We always appreciate it, folks. Tell 3 people, please, if you like what we do. That's how we grow. Wouldn't be able to do it without the great listeners like yourself out there. And I believe it was Mike, and he was talking about turning on to some new listeners and talking about just kind of going over the bigger picture of the market, okay? So I saved that one, man, because I appreciate that, and I'm sure he's not the only one. And big picture is important, okay? Talking about as we come into January 9th, new year, new trading year, quite the year last year, and you're going to have different narratives, right? The last year's narrative was a hiking cycle that we haven't seen, man, in my lifetime, okay? I think the January hike's going to be, as in the meeting at the end, it's the 8th hike. Is that correct? Maybe somebody can tell me in the den. I think it's going to be the 8th hike. And the real question is whether they're going to go 25 or 50 basis points. It's about a 50-50 right now. Thursday's CPI data is going to control a lot of where that number goes. Here's the S&P big picture, okay? We've traded down to a 50% retracement. Your first pullback, well, the first pullback got you to, it's pretty cool where these line up, right? Even on a Fibonacci level. I really like using the 382 and the 618, but the 236 is on that graph, man. And it's the first one bounces there. The second one bounces right off the 382. The third acceleration bounces off the 50%. So where's the next acceleration, folks? Right? The next acceleration, just going by the study there, is talking about the 618. So the 618 brings you down to about 3,200. Okay? And this is going from the COVID low up to the high that we started last year at about 4,808. We already made it to a price point, folks, of about 3,500. If you think 3,200 is impossible, you're not assessing the probabilities correctly. Doesn't mean it's going to happen. But impossible, or even near impossible, okay, or even like percentages that reflect that, is not where I would place that probability. Doesn't mean it's going to happen. Again, nobody knows it's going to happen. What you should try and do is compartmentalize the probabilities of events occurring, especially when you're thinking like longer term. Okay, so there's the math on how you could get to a simple 618 and you pull back to about 3,200. Bigger picture. Now the NASDAQ, they've already done it. Okay, now figuring out where the NASDAQ goes, all right, maybe that one does make its next step to the 786. And you can see that the NASDAQ, right, we just went over the S&P. The NASDAQ accelerated through the 236, but again, that second acceleration did get it to the 382. The third acceleration got you down to the 50%, and that most recent got you to the 618. So it's one leg ahead of the S&P, basically, especially when the Fed is coming into things. Okay, but lining up the S&P, NASDAQ already did it, man. Don't think the S&P can't do it. Okay, now you go back to the S&P and go a little bit shorter term in terms of, we're going to take this big picture off. We already said 3,200 gets us about to the 618. We're going to put it back on a daily, just focusing on from the highs of about 4,800 a year ago. I got to go back a little bit more than a year now to reach that high, because that was on January 4th that we hit that high, and it was all downhill from there. Now, what has been the rally that's accompanied the declines in this market? Well, we're going to take the first acceleration, okay? That first acceleration right out of the gate in January of last year brought you from 4,800 down to a price point. Now, this is where it gets to be an art, not a science, folks, okay? Where exactly do you find the bottom? Do you take the tail of a bar? Do you take a little linear regression using the lows? You can take either, okay? Taking the tail of the bar, you see how perfectly it lines up, though, that where did we bounce to? Well, you trade lower into January 24th, and it was quick, man. We wiped out 600 points in the S&P by January 24th. This is a daily, folks, okay? What do? You then climb to quite a reprieve, man. 4,600 in the S&Ps. You were there February 2nd, you were there February 9th, and you were there February 10th, and then the sell-off began. Well, where did we climb to? You bounced to about a 618 in the market, okay? So that's your first acceleration and then bounce. And you can even make the case that we bounced again pretty close to the 618. You were over that price level for about 2 days, right? Okay, we're going to clear that one off there. We take the next successive high. We're going to draw another Fibonacci retracement. Now, eliminating this one, but it is interesting to take a look at. Okay, number one, if you take the first low in May, there's 382s and 618s all over this S&P, folks. Okay? You take the short-term one, where do we bounce to? We bounce to the 382. Okay? If you take that little blip out of the occasion, because really from May 25th to June 10th, the market was back to where it was. It was only a 2-week blip, but you did see that it bounced to the 382. Okay? But let's just say we go to the next bottom and we consider it one trend to the pullback of June 17th. So that was your next big acceleration to south in terms of the run that we had from March 28th at 4,600 all the way down to June 17th, the low. Where the market bounced to? Right about the 618. And this is where, yeah, it's ballparking. Okay, you got above it for 3 or 4 days. But in general, you rose to a level near the 618 before your next sell-off. Okay, let's do it again. Where did we just go? You take the highs that we just had, and you go down to a low of where we're at. Now, that is the high from August of last year down to the lows of October. I've taken kind of the lows of the candles there. You know, you ballpark with a little linear regression, folks, and we basically rolled over at the 618 that you consolidated at from November 15th to December 15th. A nice month of consolidation. We got there originally on November 15th. You pull back a bit, you get above it again. You have the acceleration of November 30th. You pull back within a few days. You get the big spike higher on December 13th to a 4180, right? And then what? you get the dramatic sell-off, man. So keep in mind that you're at the 618s all over the place. You just reached another 618, okay? And then to compound that, which is why I think 3,200 or 3,300, and earnings season is going to be it, man. Okay, if the data doesn't line up, then the charts will reflect that. But right now, I see a severe risk that the market's going to trade lower with how we are ebbing and flowing and how we're coming into an earnings season, man. We're not out of the woods, folks, okay? All this exuberance over inflation, over last week's jobs number. I mean, I was listening to some great analysts over the weekend, man. They were talking about, hey, the Fed keeps talking about the labor force, okay? You can't pull out of inflation when you have labor numbers where they are right now. Something needs to budge on some degree, and I'm not sure that last week was it. I'm really not. So getting into one final step, talking about A to B, C to Ds, okay, where do you line up this leg? Well, number one, it could get you down to about 3,400 easy, almost 3,300, because number one, you're talking about our 618 line, lines up at about 4,035. If this is an A to B, C to D, folks, your A point's about 4,300. Your B point's 3,600, and again, that's not cherry picking that tail, which would bring you all the way down to 3,500. So if you actually took the tail, okay, and let's just activate it to show you. Number one, that brings your Fibonacci spike all the way if you're taking tails to the 786. And I'm not sure that's really reflective of the moves you've had, which is why I kind of like lining it up. And as you see, if you line it up to the bodies, it lines up to the bodies fairly well on the 618 that it had to higher price. So let's call it 700 points is your A to B, C to D. Excuse me, yes, A to B is your 700-point leg. You rise to a 618, and if you're taking 700 points off about 4,000, you're going down to 3,300, 3,340, somewhere in that ballpark. I'm going to get you in the range, folks. You know, it gets you in the range, and we'll do the big picture, Fibonacci 9, one more time. 3,174, that's where you kind of chopped around at the end of 2020 as well. So there's your big picture in terms of the Fibonacci numbers, you know. And we come into a big earnings season. We'll talk about some of the banks. When we get back, we'll talk about some of the tech companies as they're at the end of this month. And we'll talk about CPI data, what they're looking for CPI. We're going to have a good show, folks. Stay tuned. We're coming back for the opening bell.
Building wealth trading in the stock market seems impossible to most people. They think it's too volatile and risky. Most people aren't going to take the time to educate themselves on how to do it right. But you're not most people, are you? At TFNN, you'll get the guidance you need to refine your strategies and techniques to invest like a pro. Because you'll be a pro. All TFNN subscriptions, books, software, and courses are available at TFNN.com. And I'm even going to tell you how to get them for less. Use TFNN's Tiger Dollars and you'll get up to a 20% bonus on your purchase. And once you apply them to your account, Tiger Dollars are automatically used for all future or recurring charges. Tiger Dollars also never expire, are fully transferable, and are a great way to add savings to your newsletters or services. Become the investor you were born to be at TFNN.com. TFNN, educating investors.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Sharpening your skills as an investor is like getting better at playing a musical instrument. You have to practice, sure, but you also need excellent instruction from experts. At TFNN, you'll get advice and guidance from the authority in technical market analysis. And it's not just dry, tedious text either. TFNN airs live financial content streamed live on TFNN.com and TFNN's YouTube channel with Tiger TV, live every market day from 8:30 a.m. to 4 p.m. Eastern, for free. Each host is an experienced trader and gives their take on the market while taking calls and questions live from around the world. From the moment the market opens until the closing bell sounds, Tiger TV has 8 different shows with expert hosts to help you make the right moves with your money. Watch online at TFNN.com or on TFNN's YouTube channel and become the investor you were born to be. TFNN, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We got markets open. You got an S&P up by 20 points. We got the NASDAQ 100 up by 93. Tech stocks with the NASDAQ 100 up about 0.9%. Let's see how some of the big tech stocks are trading. Apple up another $1.21. That's about 0.9%. Make it a full percentage point as markets pop a bit on the open. Microsoft shares up 0.7% this morning. You got Google up a full percent right now. Amazon catching a bit, up 2.4% right now for Amazon shares. See how some of the other Salesforce up about 2% right now. Zoom shares up 1%. Roku up 2.6%. Let's see how Cathie Wood is doing, up 3.7% as growth stocks catching a bit, extending the gains that we got from Friday. So let's get into some of the numbers in terms of what we're looking for here. That's the earnings sector. Hold on one second. I'm going to jump around a bit before I get there. Forgive me as I jump around screens. There we go. Because I wanted to talk about CPI data first, and then we're going to get into tech earnings, okay? So we get CPI numbers on Thursday. December numbers, folks, are coming out. So the last number we actually have is a November number, delayed data, okay? That data for November was a 7.1% CPI. That's the last data we have. You have to really stay present in terms of letting the data drive the market, and I think the market keeps getting ahead of itself. That's why I said that. So if somebody asks you what consumer prices are inflating at right now, the answer is 7.1% year over year, okay? They're looking for that number only to drop to 6.6% year over year for December. That's the headline number they're looking for, okay? Core CPI, that's going to remove food and energy, is expected to rise at 5.7%. after coming in at 6% in November. So again, November numbers were 7.1% and 6%. All right, I'm going to scroll this over. It's just a Yahoo article with some of the numbers we're talking about here. I'm going to scroll in and blow it up so you can see. The numbers we got in terms of where we are, headline is expected to be at 6.6 and core is expected to be at 5.7 after 6 in November. Now here's the interesting thing. Over the prior month, so month over month, core CPI is expected to rise 0.3% after a 0.2% jump in November. So core is expected to accelerate, and core is expected to come in month over month at 3.6% annualized. Just keep that stuff in mind when you see this, because if you're sitting in Chairman Powell's seat, very difficult to imagine that he takes his foot off the pedal, folks, with wages decreasing as the only factor really that's coming in. Everything else is lining up for a super strong economy that's having trouble cooling, okay? 230,000 jobs added last month. Unemployment rate at 3.5%. I don't think that's going to give him the conviction to know that inflation is on its way back down to 2%. So we have some months to go. We have a meeting at the end of this month. We're going to get the core CPI right now in terms of this week on Thursday, okay? And even this week, the number they're looking for December is going to be 6.6% headline, and the core coming in at 5.7%. And look for the month-over-month core, okay? Because that's expected to rise 0.3% after a 0.2% jump in November. How this data comes out will decide 50 to 25. I imagine they might go 50 anyway, folks, unless we get a real shocker of a core CPI number. Now, the Fed likes the PCE, personal consumption, number better than the CPI, but the CPI is still a very important one. All right. We talk to our man Kevin Hincks every Tuesday, Wednesday, Thursday. He gives I like to ask him sometimes, for those new listeners out there, what are the top data points of the month, right? Non-farm payrolls that we just got on Friday, that's probably number one, and the market's loving it. Core CPI, in this environment with how important it is to the Fed, it might be number two. PCE might be number two out there as well. You got retail sales in there on top of it. You got ADP, which is an important precursor to non-farm payrolls. But core CPI and PCE are big ones. The difference, okay, between the two numbers, you learn a lot in this market because you have to know what's going on with inflation numbers. Consumer prices reflect what the consumer is actually purchasing. So where it gets different is if a third party is paying for a product you consume, personal consumption, okay, the PCE, this is how to remember the difference, because you're consuming it. There's a lot of things you consume that you don't pay for first party. The best example of that is employer healthcare in many instances. That is something that you are consuming that is reflected in personal consumption, not reflected in CPI, because you're not usually paying for your healthcare if you get it through a work-administered plan. There's many things that go on like that. Third party, you're consuming something. You might be consuming it, paying for it in some fashion, like for a job where you're getting healthcare, you're consuming that product. It's not a consumer price, though, because your employer, it's something you're consuming. So that's the two differences in numbers. That's probably why the Fed likes the PCE better, because it encompasses everything that you consume, right? Because if healthcare is skyrocketing, that's going to matter because companies are going to have to incorporate that. They're going to have to incorporate that into their wages, et cetera. So it matters what you're consuming, but CPI is probably a close second reflection. Nonetheless, you're going to get numbers, folks, that are 5.7% headline. And keep this in mind. What happens if we get a crude price that spikes? Because I see a lot of risks to the upside in crude, folks, at a price of $72, man. You go back to the weekly, okay, we're at prices that you were at in June of 2021. Now, we got huge pullbacks going on in China, right? The natural gas market, let's pull up natural gas. Yeah, look at this thing, man. They got so much natural gas, they don't even know what to do with all the natural gas, okay? As natural gas is back to basically prices that you were almost trading at in October of 2020 at under $4. But the crude conversation, if you ever get a spike there, that might not matter as much with the Fed in terms of the rising prices, but that is going to boost the headline numbers again. That's going to hurt the pocketbooks of Americans no matter what, and that could be a strain on the economy. Even if the Fed isn't going to care that crude prices are reflected in a headline CPI number, because they don't have that type of control. That's why they like core so well, because the core numbers they can influence to a greater degree with interest rate policy. They are aware that they can't, let's put it this way, it's very difficult because you can, but the effects that you'd have for the damage you do would not be worth it, right? They could hike rates to the point where people would struggle to pay for gasoline, to travel, to put it in their cars. That's a death scenario. For the impact they'd have, it wouldn't be worth it. But they can slow down the economy to a degree. So they can't influence food and energy as much because there's components in those volatile categories, which is why they like the core number. So we're really going over the numbers, but it's important, man, because everybody's getting pretty excited that we're supposed to get CPI numbers that are coming in at 5.7% on a core basis and 6.6% on a headline basis. And we are in January of 2023, folks. So take that for what it's worth as we come into those numbers. Yeah, because you take a look, consumer prices, we are in a downtick, okay? But here's what is weird about this downtick right now. There's your headline number, okay? That has been helped by crude dramatically, that turnover, okay? Helped by crude dramatically in that number. And that's not reflecting, as I said, that on a core basis, we're supposed to go up 0.3% from November to December. That is a rise from the 0.2% we got for the month of November. All right, folks, stay tuned. That's the CPI. We're going to be talking about tech earnings when we come back, talking about some of the earnings estimates, some of the multiples. We'll be right back, folks.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.com, educating investors.
The technology around us is changing every day. With so much happening, it can seem impossible to keep up with all the information. David White's investment newsletter, The Technology Insider, is designed to give you all the information you need to understand the technology that shapes today's markets and tomorrow's future. David White has made his living staying on the cutting edge of technology. His weekly newsletter will give you specific recommendations for value tech stocks, as well as entry prices, target prices, and stops to set for each trade. Dave delivers his weekly newsletters every Friday with updates throughout the week. You can get the Technology Insider at TFNN.com for only $37.50. Sign up for David's newsletter, The Technology Insider, and get an inside look at everything the technology sector has to offer. Try it risk-free today with our 30-day money-back guarantee. TFNN, educating investors.
Will the S&P 500 continue to climb? For bold trades on U.S. large cap stocks in either direction, trade SPXL, SPUU, or SPXS. Directions Daily S&P 500 Bull and Bear Leveraged ETFs. Direction Leveraged ETFs. An investor should carefully consider a fund's investment objective, risks, charges, and expenses before investing. A fund's prospectus and summary prospectus contain this and other information about Direction shares. To obtain a fund's prospectus and summary prospectus, call 866-476-7523 or visit directioninvestments.com. A fund's prospectus and summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors. Distributor Foreside Fund Services, LLC.
This program is brought to you by Vista Gold, traded on the NYSE American and TSX under the symbol VGZ.
Excuse me. Welcome back, folks. We got the S&Ps right now holding on to most of the gains. We're up to 39.44. Right now, you're trading up 20 points, basically where we came into the open. That's a 15-minute. Let's put it back on a 5-minute. You can see that spike right on the open to 39.44. But right now, trading by about 0.5% in the positive. We go to the NASDAQ 100. We're going to talk some tech stocks right now. You get the NASDAQ 100 up 86 points. That's 0.75%, 11,200 as it hits that number. Now you take a look. As I mentioned in the early part of the program, man, you already got a 618 pullback in the NASDAQ 100. Quite the pullback indeed, man. Did you think that you could get a 618 pullback, folks? Sometimes you don't think it, right? You don't think it's possible. As in, if I had said to close out the year last year, and people were looking for pullbacks, folks, but I don't think they were looking. You had a leg that was 6,600 to 16,700, 10,100 points. You traded higher. And I said, man, we're going to give back a 618 by the time that we reach October. You're going to give back a 618. See, the proper reply would have been, of a 10,000 point leg, you think we're going to give back a 618 in the next 8 to 10 months? I mean, you gave back, almost 6,000 points by June. Would have been met with skepticism, rightfully so. But that's the market that we're in right now. NASDAQ 100 up by 0.9%. And we jump over. So earnings, this is a Bloomberg article out this morning, remain key risk for tech stocks after worst year since 2008. Analysts right now see the tech company profits dropping 2.2% this year. Okay. Inflation and valuations are additional headwinds, of course, for some of the biggest companies out there. That's the pullback that we just went over. Lines up right to about the 618 of the full run higher you had from the COVID lows of 6,600 and change. Now, you get into the numbers of these companies, okay? Couple quotes in here. Yeah, last week profits at tech bellwether Samsung dropped by the most in more than a decade. Anecdotal, but nonetheless. You have a founder of data tech Trek Research. The companies are not improving, and on the margin, they're deteriorating. For growth stocks to work, you want to see improving fundamentals and estimates, and we're not seeing it right now. Now, getting into some of those fundamentals. NASDAQ 100 was down 33% last year, biggest drop since 2008. And it just mentions that while we're up marginally, less than 1% in 2023, you actually, coming into today, had Apple, Microsoft, and Alphabet all in negative territory. Key test is going to come in the coming weeks as we get the results of their earnings. You have layoffs to some companies. Tech sector earnings, this is how the headline began, right? Expected to fall 2.2%. Excuse me, as I look on 2.2% this year, compared with a growth of 2% for the S&P 500. So you got to separate the two again. This is not a full market forecast, okay? S&P 500 growth expected to be at 2%. This is according to Bloomberg intelligence data. You have the tech sector falling 2.2%, okay? Now, that drop, though, has only changed in the last 3 or 4 months, and some think it's going to change more. So here are the numbers. The consensus has dropped dramatically over the past few months. At the end of September, which feels like yesterday, folks, tech earnings had been forecast to rise almost 5% this year. What? And many expect analysts will cut their estimates even further. And if they do, that would make the stock appear pricier by lowering the denominator in the PE ratio. They really break it down, right? Now, well, okay, maybe where are we on the PE schedule, right? Where are we right now if we have problems with earnings? Because are you telling me that they just changed the earnings from a 2.2% from a 4.7% growth at the end of September to now a decline of 2.2% in the last 3 or 4 months? Well, it would be surprising if that stopped on a dime. Very possible that they lose more than that, okay, if earnings fall more than 2%. Now, the S&P 500 tech sector still trades at 20.1 times earnings. The 10-year average is only 18.9, man. Yeah, and the S&P 500 is 17. Well, it should be higher than the S&P 500, okay? But you're talking about a 10-year average of the tech sector, folks, and that's not cherry picking lows, man. Let's see how far back the NASDAQ 100 one goes back. Let me see. Yeah, that gets us back as far as we need to go. And what did I just say? How many years? 10-year average. Yeah, so we're only going back to 2013, okay? So from this price point, and I'm just taking the NASDAQ 100, okay? And it's been quite a run, but my point is, you're not taking the PE average from the years of 2009 to 2012 or from 2012. You're not taking any of those PE years. So the price reflection over that time, and it got stratospheric would be the term in terms of that run up to 16.7. But realize we're sitting at 20.1 times earnings. It's above its 10-year average. Earnings are a problem. The Fed is still hiking. You know, if the data lines up, it's going to line up, folks. But I would pay attention to that data because they're going to wait for it, man. And it's not quite here yet. When you take a look at some of the cheapest NASDAQ 100 stocks, you have Meta on there at 12.4. Interesting, some of the companies in the NASDAQ 100. You have the energy stock at the lowest, 5.8. You have Walgreens Boot Alliance with a decent PE ratio of 7.9. Comcast, Charter, eBay, Qualcomm, NXP, Paccar, and Microchip rounded out Meta at 12.4. So if you're looking for a little bit of value, man, maybe Meta, but keep in mind, last year, 64% fall. That drop cut Facebook's PE ratio to 12 from 28 a few years ago. So keep in mind, NASDAQ 100 is above 20 right now. You just saw Meta, which is in a perfect storm, granted, go from 28 to 12. Man, oh man, right? Yeah, so those numbers important when you look at these tech companies, okay? And as we mentioned, they're coming out the last 2 weeks of the year, basically. We jumped to some of these companies. Let's take a look at the earnings. Yeah, Amazon and what did I say? Apple, I believe, are going to be February 2nd. Let's go to Apple, too. They're a little bit more spread out than they have been in past quarters, I think. So Amazon and Apple are February 2nd. Microsoft, okay, it's just the prior week. Yeah, so they come in over 2 weeks. Sometimes they're in the same week. Microsoft is going to be the 24th. I think Google, January 31st, and Meta, February 1st. So all of them right around there. You start at January 24th, and then we come into the banks, of course, at the end of this week. And let's take a look at some of those banks. We'll start off with JP Morgan. You're basically flat today as you have the markets accelerating higher. And what do we got? We got the 10-year, just checking it out, up 2 ticks right now. So let's kick it off again. JP Morgan, you're basically flat. You give back some of the gains. I'm going to jump over to their numbers. So they're out with the numbers Friday morning, and you got about a $4.62 move priced in either directions for JP Morgan. We're looking at the expected move here. Okay, Morgan Stanley is not included in there. They're next week. Is Goldman? No, Goldman's not as well. When is the 17th? So that's Tuesday. You get Morgan Stanley and Goldman Sachs, I believe. So it's going to be all the retail banks coming out. JP Morgan, yeah. Citi is going to be out. They got about a $2.19 move priced in. Bank of America, out on Friday morning, about $1.40. Wells Fargo, out Friday morning as well. Almost a $2 move priced in for a $42 stock. All right, folks, stay tuned. We got one more segment coming up. We got markets accelerating higher, man, with the S&P up by 30 points. How about those tech stocks? Up 1.5% right now. We jump over to Apple shares, up 1.3%. Amazon, up more than 3% this morning. Stay tuned, folks. We'll be right back.
TFNN has just launched their new trading room, the Tiger's Den. Hosted at Discord, TFNN has been educating traders for more than 20 years with live programming hosted by a variety of professional traders during market hours. And now they are expanding their reach with the Tiger's Den. Available to all tigers and tigresses for just $1 for the year. There's no catch or added costs when you join our community of traders. In the Tiger's Den, you can look over the shoulders of Tom O'Brien and the other TFNN hosts while they analyze charts during their live Tiger TV programs. And join an interactive trading community with hundreds of members exchanging ideas. Interact with other tigers and tigresses as they share trading ideas, news analysis, and discuss the market action all trading day, even at night and on the weekends. The Tiger's Den at Discord is accessible on mobile or tablets as well, so it's always at your reach. To sign up today and become a part of this educational community of traders, just visit the front page of TFNN.com.
You might think that if you want to be successful at trading in the stock market, you're going to need a crystal ball. After all, it's impossible to predict the future, right? Like any endeavor in life, before you decide it's impossible, get some advice from the experts. You might find that it's not so impossible after all. For daily market overviews that give you direction on the key indices, selective stocks, and commodities, subscribe to the Opening Call newsletter at TFNN.com. The Opening Call newsletter is written by Basil Chapman, creator of the trading methodology known as the Chapman Wave. The Chapman Wave up-down sequence gives you an edge in identifying price turns, finding the peaks and valleys in stock prices. Get the Opening Call newsletter by Basil Chapman in your inbox every day. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know, and you'll get a full refund within 30 days of signing up. TFNN.
Everything in the universe is governed by the Fibonacci sequence. This mathematical principle is responsible for everything from the most aesthetically pleasing artwork to patterns in the stock market. To stay on top of stock patterns you can take advantage of, sign up for the Fibonacci 24/7 newsletter at TFNN.com. When you subscribe, you'll get a weekly report from veteran day trader Larry Pesavento on stocks you need to pay attention to. And you can trust Larry's analysis. After all, he's got 45 years experience as a day trader. Larry will also provide daily charts, videos, and data on the key markets that he's tracking. Expect notifications from Larry on market movement you need to act on at any time. First-time subscribers also get a 30-day money-back guarantee. If you're not satisfied, let us know and you'll get a full refund within 30 days of signing up. Subscribe to the Fibonacci 24/7 newsletter today. TFNN.com, educating investors.
This segment is brought to you by Thinkorswim. For more information, just click the Thinkorswim banner on the front page of TFNN.com.
Welcome back, folks. We have the market right now, higher price. You're talking about an S&P pushing open market highs up 32 points at 39.47, just a few points off of the high at 39.51, and the NASDAQ basically right near those highs as well. You're up 1.6% in the NASDAQ 100. And we take a look at Tesla. Tesla getting a pop following the acceleration it had on Friday. You're up another 7% for Tesla. Here's all I'll say here, folks. Number one, you almost can't see the pop that you have going on right now if you take a look at this chart. In any context, percentages on small numbers can be deceiving. So yeah, you're up 7% today off of quite a number. This is just where this stock has been since September 21st. Now, what I did here is I pulled up two different Fibonacci trends, folks, and we have a little bit of confluence taking place with the 382 of the larger trend being that trend that started from September from 300 and change down to 100 and change, okay? And then you take the shorter trend, which is kind of that second leg that you had, started in November 1st. Now, you could take one maybe from where you were December 1st, too. Okay, but if you take that second leg, you have the 618, you have the 382 of the larger trend, the 618 of the shorter trend, kind of brings you where you consolidated. Back in that area of November, that would bring you to 186, man. And it would be quite a market if you got Tesla up to 186 before trading to lower prices in pretty dramatic fashion, folks. Be careful on that equity, though. Catching a pop. Nonetheless, and let's just clear these right now and do that. You know, just zoom in. I want to see where this one lines up as well. Because the point being, we've had such a run lower in this thing that even a 382 of the recent acceleration that you just got in December brings you up to 140, okay? Even a 382 of just what this stock did in a month, basically, gets you up to 140. So shorter term trend, yeah, you got some volatility, which is a trader's best friend sometimes. But if you're really looking for a position, boy, be careful, because you got a lot of volatility in this market, to say the least, on Tesla. And yeah, we got markets pushing highs. We got the Dow up 133, growth stocks leading the way this morning. It's going to be an interesting one, folks. Thanks so much for tuning in to start your day. Stay tuned. Live programming all day at TFNN till 4 p.m. Eastern time. We got Basil Chapman up next. We have our man Steve Rhodes at 11 o'clock, Fast Market from TD Ameritrade at noon. We have our man Larry Pesavento at 1, Dave White at 2, and Tom O'Brien, my dad, live from 3 till 4. Stay tuned, folks. Have a great one.